So the Federal Reserve cut rates again today, and some interesting things happened throughout the meeting. Two members dissented, which is unusual. Steve Mnuchin, a recent addition to the Fed, dissented for 50 basis points. Jeff Schmid dissented for no cut. Dissents like this are pretty abnormal. The Fed tries to reach some sort of consensus, but the Federal Reserve is having a hard time. The loss of data due to the government shutdown, which has already cost $18 billion this year. The Federal Reserve is trying to make sure things don't get too expensive and that anyone who wants a job can have a job. That's their dual mandate: price stability and maximum employment. The two are moving in opposite directions right now. Tariffs are creating problems. There's an interesting pricing lab paper out on that showing that there is a 20% pass-through rate. Firms are passing tariff costs along. The labor market has been weakening for some time now, and it's increasingly getting more intense with these job cuts. Jerome Powell made it very clear because of that uncertainty, it's not sure if a rate cut is going to happen in December, which very much upset the stock market. The Federal Reserve also ended quantitative tightening. There's both quantitative tightening and quantitative easing. Quantitative easing is when the Fed buys assets like treasury bonds and mortgage-backed securities. The way that you can think about it is the Fed is squeezing water into the system from a wet sponge. They're wringing it out. They're buying bonds, they're adding liquidity. But when they do quantitative tightening, they stop buying those assets. The balance sheet gets smaller and it takes money out of the financial system over time. It's kind of like the Fed using the sponge. They start absorbing water. The system dries out a bit, money's tighter. And so now they're saying, hey, we're gonna stop mopping with our sponge. Less money will be drained out of the system over time. Markets will have more cash around. And so the Fed is really putting on the brakes, right? With monetary policy comes fiscal policy, and trade deals are a part of fiscal policy. So Bloomberg has reported that NVIDIA Blackwell AI chips will be on the negotiating table following NVIDIA's lobbying efforts to have them on the table. It would be major, huge. It seems that NVIDIA would make a ton of money. They are, a $5 trillion company, so I think it's good to go after $6 trillion. China maybe buy some soybeans if they get these chips. Soybean farmers are very upset with Trump because Trump essentially destroyed the relationship with China and then gave $40 billion to Argentina. Then Argentina started selling their soybeans to China. But what's tough about this AI situation is that it's essentially selling out the US AI advantage of compute, the very thing that we have staked this economy and stock market on. It would give China a massive edge. Selling those chips, even a slightly slower version, means narrowing the US's AI lead dramatically. Analysts estimate it could cut the AI compute advantage from 31-1 down to 4-1. America's biggest things are trust and technology. The Fed protects one, and NVIDIA represents the other. And it's important that we protect those.